Good day and welcome to another broadcast of Venture Capital Fund. This program comes to you with the kind compliments of Global Branding and Marketing and Venture Capital Inc. Today we continue on this several-part series that looks at business startup and investment capital. So far we have looked at two of those series, and today we'll be looking at the third. Today we'll be looking at business startup and funding sources. Under today's topic, we will be looking at the commercial financial sector, investment financial sector, and smart capital market. So what we will do, we'll take the first topic today, we'll do a deep dive and ensure that you fully understand that. And in the next 2 days, we're going to be looking at the investment financial sector and smart capital market. And you need this information for your business startup solution. Now, let me say a couple of things. The mission of this channel and the programs that we're doing, they're all aimed to position our clients, employees, and strategic partners to understand, create, and leverage passive income cash flow, build multiple streams of income, and leverage smart investment strategies. In our program, you will learn about financial literacy in the commercial financial sector, financial intelligence in the investment financial sector, financial intelligence for smart capital market. Last but not least, you will learn about financial intelligence for a sustainable livelihood. Most importantly, you will learn that financial intelligence goes beyond your ability to make money and maximize your disposable income. It addresses the issue of understanding the commercial financial sector, the investment financial sector, the smart capital market. It's about understanding the global financial system and leveraging this intelligence to create good debt cash flow, minimize existing debt financial portfolio while you maximize financial and equity capital gain. The understanding of the commercial financial sector, the investment financial sector, and smart capital market are an important body of knowledge for you to have in the global landscape of financial intelligence. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the multiple best-selling author for several books, including Billionaire Codes and Manager's Toolkit. These two books are already bestsellers. I want to encourage you to log on to our sister company website, which is www.megamoneygy.com, and you can navigate that page, that website, to get more information about what we're doing. On the front page, you will see the book. You can make a purchase of this book online. You can inbox me directly, and I'll be so willing to get your copies of these bestsellers on your desk. These books will literally transform the way you think about business, the way you do business. And on my newest book, I'm working on a very new book entitled Psychology of Branding and Marketing, and that will wow you. However, let's get into today's program. We are looking at business startup and business solution. And today we're going to be talking a lot about the financial sector. Today we will do a little deep dive into what is known as the commercial financial sector. Why? Across the Caribbean region world, we see that many business startups, especially in the Caribbean region, when you are going to start a business, the first things that comes to mind is capital. The first place of funding sources that comes to mind is the commercial financial sector. And what we see happen very, very often is that many of these business startups tend to complain about a number of factors relating to the commercial financial sector. You speak about high interest rates, you speak about the red tapes. associated with accessing the capital. Some of those red tapes relates to things like there's something that we call the pre-qualification criteria to accessing commercial funding. And the pre-qualification begins by looking at your balance sheet. Now, what exactly does this mean? What it simply means is that if you're going to the bank and you need $20 million to get your business off the ground, the bank obviously will ask you to demonstrate that you have 10% equity. In some cases, the equity can be cash equity or asset equity, but they will ask you to show that you have the equity to at least put 10% of the investment sum into that business portfolio that you are considering to start up. So if they ask you for the cash equity, it simply means that you need to have about $2 million as positive income sitting in a bank account or sitting somewhere that you can have easy access to present that to the bank as part of the pre-qualification criteria. Now, having access to the 10% or 20% that the bank may ask for, so if it's 20%, they're going to ask you for $4 million, and the $20 million that you're asking for, you would need to have this. But this is not all. This is the first leg of what is known as the pre-qualification criteria. The other element of the pre-qualification criteria is cash flow. All right. In over 90% of the cases, the financial institution wants to see your cash flow. Why is the cash flow necessary? Because it shows that you have hourly, daily, weekly, monthly income that is coming into your place of business, and they can evaluate that cash flow to see if you are making a positive or a negative cash flow. Judging from all of this is where they're going to be able to assess your pre-qualification criteria to access that $20 million loan. Now, it may not necessarily be only about seeing if it's positive or negative, but also seeing the large amount that is actually coming in so they can do their necessary financial deduction to predetermine if the leftover from your daily, weekly, monthly income will leave enough for you to service your debt cost. Now, this is not all. The third leg in the game is looking at something that we call the credit score. Now, financial institutions across the world are doing your credit check. And what the credit check allows them to do is to assess the debts that you have and more so assess your ability to honor those debts, to assess how have you been treated with debts that you have. All of this will help to find the financial institution to make an informed and educated decision in terms of providing the much needed capital that you need to scale your business. Some of the things that we talk about, and we know that in some parts of the world they do have this, while you may have your credit score, you have your credit score, and let us say as a private individual, you're taking out debt and you might have some negative payment history there. But that's with your personal credit score history. In terms of your business credit score, we argue that there should be a separation between your personal credit score and your corporate credit score. In some parts of the world, we know that we do have that. In other parts of the world, you may not have it. So whatever you do at a personal level may come back to bite you at a corporate level. We think it's unfair. Now, these are all some of the pre-qualification criteria that you may have to look at, but this is not all. The fourth leg in the game is something that we call collaterals. In many cases, the financial institution may still ask you some collaterals. And when you get past collateral, another thing that's fifth leg in the game that I want to talk about today is that age do matter. And in my book, Manager's Toolkit, all of these things that I've just mentioned are written in this book. Age do matter. Why? Because a young person at the age of 20, 25 who's looking for a bank loan, you may have one disadvantage in the sense that you may not have the knowledge and the experience as much as to build the kind of credibility for investors to want to put a large sum of money in your hand. On the flip side of that, when you reach 45 and 46, 47, 48, 50, while you now have the experience and the knowledge in terms of doing, business, and from that, knowledge standpoint and not so much the emotional standpoint, you have another dilemma. Because the older you are, and this is why we say age do matter in my book, we say that from the time you reach 45, when you're climbing up into 50 and beyond, the life cycle of your debt is affected. Your life cycle is affected from the standpoint that at 20, you will be able to get buy a debt for about 25 years. At 45, 50, you're not going to be able to buy that debt for 25 years. The longest you might get is 10 to 15 years on the life cycle of your debt. So what that means, in financial terms, that means a whole lot. It simply means that your monthly payback on the debt obligation is going to be much higher. And if it's going to be much higher, it's going to be much more, strenuous on you to find the capital, especially in a business startup, to honor your monthly obligation to the financial institution. So these are very, very important things for you to understand as the pre-qualification criteria before you even go to the financial institution. Because when you go and the financial institution says that you do not reach the pre-qualification criteria, you become frustrated. And in most cases, the financial institution may not necessarily explain everything in the way that I just did for you to better understand why the financial institution is saying no. Now, when you come to venture capital Inc., venture capital fund, global branding and marketing, what we're able to do is to do that deep dive into your business profile. And in doing that deep dive, we help you to navigate the pre-qualification criteria long before you get to the financial institution. So we can do a credit score check. So you know that this is one leg that you have completed. We work on your balance sheet check. So you know that that's the second leg that you have in the game. We look at your cash flow. You know that that's a third leg that you have in the game. On age, and there's a way in which we could mitigate the age factor. When you come into our masterclass program, we normally say age matters, but we have a system also that we can help you to learn where age doesn't matter. And these are all legal, legitimate systems that we will expose you to when you come into our masterclass program. So in looking at the business solutions, and these are a number of aids that we bring to trade, to your commercial transaction, and to your effort as a business startup to source capital. The input that we're making really helps to reduce your stress level and position you to act from that position of strength, to act from an informed position, because you know that you have a better chance of succeeding with this. But let me say what? In our portfolio, we really emphasize a lot. In my best-selling book, I talk about that a lot. In most cases, when you are going to create a debt, All you're seeing is the debt as an asset. You're not necessarily seeing the debt as a liability. And yes, the debt is an asset because you're going to be able to leverage the debt once you're successful to do creative, innovative things with your business. But there's something that we call also um, debt management portfolio. And just let me walk you through this a little bit. There are smart ways to manage debt. And in our portfolio, it begins by you understanding what is good debt and what is bad debt. In our portfolio, it's important for you to understand how the wealthy create debt and how smart people create debt and how smart people manage debt. Now, in most cases, you are not aware of if your debt is a good debt or a bad debt because all you're seeing is that you're going to be having cash, you're going to be liquidized, and in this process, you're going to have liquid cash to do the things that you want to do. But in doing the things that you want to do, you don't have a clue as to whether it's going to be a good debt or a bad debt. And there are ways in which you can actually predetermine whether the debt that you're taking is a good debt or a bad debt. Some of the things that we expose you to at venture capital, fund venture capital in global branding and marketing is what we call our debt management or debt analytics. So before you take that debt, we work with you to do your income projection. You should have your strategic business plan at all times. If you go to a financial institution, you would need to have it. All right. So we work with you to look at your income projection. Uh, and of course, the way we go about doing your income projection is not by pulling information out of thin air. You have to get solid market intelligence to be able to arrive at your accurate financial projection. Look back at some of my earlier programs and you will see these things that we are talking about. The second thing that we work with you on here is that your expenditure projection. You must know the cost for labor, the cost for operating the business, and you have to come to be able to deduct all of those costs from your income, which will bring you to something that we call your net operating income. And later on, you're going to be looking at your NOI. So these four important things are very important for you to understand. Income against expenditure, expenditure leaving you with a balance sheet, your NOI, and your ROI. But we don't stop here. There's something that we call market analytics. And this is where many business startups do not do. You have a business startup idea, you're excited about that business startup idea, you're emotionally involved with the business startup idea, and you just want to get started. But there's something that we call market analytics. And here is where you want to be certain that you know your target audience. Here is where you want to be certain that you understand your competition and the level of market forces that influence buying decision. Here is where you want to know that you know in your market analytics that the market is accommodating and the market is enabling. Very often, when you start the business operation and you start to feel now the market forces, is when you start to get jittery. You're jittery, not the time to be jittery. And because at this point, you've got some serious skin in the game and you've got some serious financial obligation to be making on a monthly basis. So it's important for you to be able to put these 5 things together and apply them long before you create that debt. Most people wait until they're in a crisis situation and then they come to us to do their debt mitigation. And yes, some of the solution is the debt mitigation. Now, I started off by saying that many business startup companies Many businesses complain about working with the commercial financial sector. And some of the things that we commonly hear is that the cost of capital is high. I want to say this, the cost of capital may be high. So is that a good or a bad thing? I'm not going to say it's a good thing. I'm not going to say it's a bad thing, but I can say it can certainly get better. I make that statement largely based on the fact that someone who understands financial intelligence can take a capital that is coming at a high cost and leverage that debt in a smart way that significantly exceeds the cost of that debt. The debt is where you have your principal and interest, and because of your knowledge of financial intelligence, because of your knowledge of the financial market, you're able to take that debt up and level that debt way beyond the cost of that debt. So to you, it does not, affect you in any significant way, except in a positive way, because you understand the power of OPM, and you leverage the power of OPM. These are systems across the world that are used. And later on, as we start to talk much more about financial intelligence, we will bring this information to you. But what I quickly want to say is this. Don't wait until you're in a debt crisis to try to figure the way out. Sometimes it's too late. We see people with their home mortgage wait until they cannot really honor that debt. And 3, 4, 5 months would have passed. And then the panic attack steps in, and then they run to get assistance. At this time, they're seeing how can I cover the debt? And for us, we got the solution-oriented thinking has to kick in, because what we see is an asset. We see an asset that has a debt cost, but we also see an asset that has equity appreciation, and the equity in the asset, it's much higher than the debt, the entire debt portfolio. So how can we help the client to get out of this conundrum, to get out of this crisis? We do figure out ways in how we recommend that clients get out of that. Cash out on the equity and leverage the equity to get their feet in the game again. I'm saying to you as an entrepreneur, do not wait until you reach this point with your business to start figuring it out. So the solution is that when you come to us at Venture Capital Fund, Venture Capital Inc., because of the subject matter experts that we have that deals with financial intelligence, we are in a position of strength to really help you to navigate all of this. A quick analysis that I want to do in concluding today's broadcast is that, let us suppose you are able to go to the commercial bank and you take out a debt of about $20 million. That debt is being, you buy that debt at a cost of about 10% interest rate and per annum. And the life cycle of that debt is going to run for about 20 years. Now, you don't have to be a rocket scientist to do the mathematical calculation. 10% on 20 million per annum is going to be $2 million. So what that simply means is that your debt obligation to the financial institution on an annual basis is going to be $2 million. And that represents interest and principal and interest. But in most cases, this is all you see, your annual obligation. From our perspective, what we see is the life cycle and the life cycle cost of that debt. The life cycle of that debt is 20 million. The life cycle of that debt is 20 years. The yearly obligation is $2 million. 2 million multiplied by 20 years is going to give you a sum total of $40 million. But the principal that you would have borrowed from the bank is $20 million. So what that simply means that you borrow a debt of $20 million and you're paying $20 additional million for the cost of that debt. So your total debt cost here is going to be $40 million. Is that good or is that bad? I'm not here to say it's good. I'm not here to say it's bad because I can do economic analysis and appreciation and depreciation of the economy to give an analysis there. Our role in this whole process is to show you, the business startup or those who are in business, is to show you a way in how you can better mitigate your debt. Because you buy a debt at $20 million, life cycle 20 years. Can you reduce your debt cost? Yes, you can. Can you cash it on the equity earlier in that debt portfolio? Yes, you can. And here is where we come in. All right, so I'm going to stop here for today. I think that I gave you enough food for thoughts, and I trust I will have given business startup a number of solutions in terms of getting your business off the ground. In starting, and we start to dig in deep, we look at your pre-qualification criteria. Get your pre-qualification criteria right before you go to the financial institution. You want to get your balance sheet right. You want to get your cash flow right. You want to get your credit score right. Age do matters, and some collateral, more collateral will never hurt. So we look at all of this and we look at some other issues. So I trust that you really enjoy today's program. Remember, if you're looking at this program for the first time and you have never subscribed to this program, I want to encourage you to give us a thumbs up. We will totally appreciate that. And press that subscription button and the bell on our YouTube channel, so you will be the first to get these programs on a daily basis that we are bringing to you. My name is Gary Thompson. I'm a business development consultant by profession. I'm a humanitarian by nature, and I'm the multiple best-selling author for several books, including Manager's Toolkit and Billionaire Code. These two books are already best-selling books, and I've talked to you today from some of the information that are in this book: Manager's Toolkit, How to Build a Global Brand. So I trust you would have enjoyed it. So you be blessed and ensure that you're protecting yourself against COVID-19. Remember, COVID-19 doesn't discriminate. And so you want to be the one that is going to be smart and protect yourself and protect your loved ones and ensure that you are safe as the world tries to come to grip with this new reality and figure out how to mitigate this process. So be blessed, live in love, unity, and care for each other. We are at Venture Capital Inc. Global Branding and Marketing Venture Capital Fund. We have a team of subject matter experts that are here willing to provide expert advice to you. We have a team of PFAs, professional financial advisors, personal financial advisors, economists, accountant, business consultant, that with the combined years of over 75 years of experience in this business. And we want to bring all of this and put all of this to work for you, to ensure that we can help you to scale your business, your idea, your brand with local, regional, and international relevance. So feel free, reach out to us for a free consultation. We'll be so happy to engage with you. So be blessed and see you on the other side.